money will only get you so far. Relationships to me are everything. Mm-hmm. And when you look at the relationships that we have, I kind of chuckle whenever I'm like, I can't imagine like some of our clients going into another financial advisor's office. It really, it gets me sometimes because I'm like, what would they like say? And obviously I'm biased.
Yeah,
okay.
Yeah.
I'm very biased.
But still, how would that go?
Yeah. But how would that go? Like when you look at the returns, when you look at the relationship, the money's there, the relationship's there, what more could you need? Like it's, I think if we did anything else, it'd probably be illegal. Welcome to the show. This is the Build Big, Live Bigger podcast. This is where you get real clarity about retirement so you can build a plan that blesses your life instead of becoming it. We'll share what you need to hear to replace worry with confidence, protect what you've built, and actually live your dreams, not your fears in retirement. Let's dive in. Hi, my name is Johnathan Burgess. Welcome to episode 22 of the Build Big, Live Bigger podcast. I'm here with my co-host, Luke Maloney-Grimes. Welcome on the podcast, which I guess maybe I'm a guest after you and Teddy ran the last one.
I think you've probably done more than me.
Yeah.
So, yeah. I guess I'm your guest.
But we're one before our Michael Jordan episode.
That's right. Number 23, MJ.
You got it. But today, Luke and I wanted to talk about something, and it is what could be eating your portfolio without you even knowing it. And if you say you don't pay them, you just don't know where they're coming from because they're for sure there, and that is fees.
Yeah, that's true. And honestly, it can be one of your biggest expenses that most people don't really realize because you don't see it. It's not in your bank statements.
Yeah.
They're hidden a lot of the time. So let's definitely unpack that today because I think it'll be interesting.
Yeah, and the reason why we think it's so important that retirees know about it, if you think about a retiree, as they get older, they get more conservative with their money. And so as you get more conservative, what generally will go down?
You'll be shifting to safe assets.
Yeah, right. And when you shift to safer assets, normally they make a lower
return.
Yeah,
overall.
So if you're making less money because you're trying to be safer with your money, which is totally valid, you should be thinking that way. It's not about how much money you make in retirement. It's about how much money you keep. The reason why I think it's so important for the group that we serve is if you were making 4% and paying 1% in fees, you are giving away 25% of your return.
Yeah. And
so the general rule of thumb is we like to make sure that you're not paying any more than 10% of your annual return out in fees. So, you want to make sure you are getting what you're paying for. But a ton of people, at least we see it every single day, are paying fees for absolutely no reason.
Yeah, we've seen that many times. Is that they've been paying constantly advisory fees or even fund fees or even platform fees that really don't give them anything. And somewhere else, they could be getting much, much, much better service for a lower price overall.
Yeah. So we're going to be talking about fee elimination today. And one of the things that I have talked about in the past, and maybe you guys have heard me talk about this example, but it's the jockey example with the horse. You remember that one?
Yes, I do.
Yeah. So, if we had a racehorse and we stick Luke on it at 180, somewhere in that range.
I think I'm above 190 now. Yeah. I'm trying to gain some muscle weight again.
Oh, there you go.
Yeah,
there you
go. My
way. He's bulking up a little bit. Yeah. So if he's 190 and we stick him on a horse and then he runs the race with that same horse, puts down a good lap time, and then let's say he gains, 50 pounds. He just really doubles down on Wendy's.
Right.
The Baconator.
Yeah.
He has a Baconator for breakfast, lunch, and dinner for 4 months straight. And he's up to 230. If he gets on that same exact horse, if that horse is in the same exact physical shape, even though it's a really good horse, Luke at 180 or 190 versus Luke at 230, 240, that's a totally different lap time. And fees are the exact same thing. You could have an investment that's a really good investment, but if you tack on all these different fees around it, you can pay a significant amount every year of your return, what should be hitting your account.
Yeah, totally. It can be crushing your returns, but also, in other words, long-term, your dreams as well, because overall it has a big impact. So making sure that you're, paying enough for the right service.
Yeah. So Luke and I are fortunate enough to, I don't know, we've analyzed thousands and thousands of client portfolios at this point in our career. But, what are some of the vehicles that you see, maybe it's more obvious that someone's going to have high fees? Like if you hear a couple words, you're like, that's probably a high vehicle.
Definitely mutual funds. That's the first thing that pops out to me, for sure, because, they can be littered with many different fees. I mean, like many of our listeners probably haven't read a actual prospectus of a mutual fund, but they have many mutual funds. The hard part is that a lot of the time you need to go through that whole prospectus to know what you're paying fully. So there's so many fees. There can be load fees. There could be back-end fees, there can be admin fees, expense ratios, marketing fees, and they can really be, on the right, on the left, top, bottom, off the side, and off in the middle as well. So like there's so many different fees that could be present. So mutual funds, number one, they have the capacity to really charge you in many, many different ways.
Plus on top of the fees, this is just a side note, complexity,
yeah. That's the tough part, is obviously you have all these different fees, but it's you don't know what could be hitting you. So just the complexity itself.
Even getting out of them, we've seen some difficulty before with clients around, maybe we adopted some mutual funds. It's very difficult. Maybe they have certain dates that they have to be traded on, but just above and beyond the fees, even the complexities that, you don't see in an index fund or an ETF. So mutual funds for sure. What's another one?
Another one, well, not many listeners probably in these, but hedge funds as well. If you're in a hedge fund at all, they can be like a 2 and 20. So you pay 2% roughly per year, and then also 20% of the actual return itself. That's another one. What about you? Do you have any
variable annuities?
There we go.
Say variable
annuities. Of course. I'm thinking more like on the growth side, on the investment side. But yes, you're totally right. Even in insurance and annuities, for instance, variable annuities are another great example. They can be they're typically the highest fee product, typically the highest fee, at least insurance investment. So
yeah, and we've seen those range anywhere from 1.5% per year on the very, very low end. I would say I've maybe seen one of those up to consistently 4.5% per year in fees. And think if you were making 7% or even 5% as a retiree, if you're paying 4.5% in fees, you're giving away 90% of your money every year to fees, and it happens all the time.
It's a lot.
And people have no idea, how that eats away at their return. So one of the reasons why I like to look at fees, especially at the beginning of the year, we're in January. I think this is going to air in January. Well, it would be the beginning of February or end of January. But, every year in January, what I do is I sit down and I look at all my expenses. So I don't spend an exorbitant amount of time going through every line item all throughout the year. I'm very much, I think this. I'm very much on the side of like abundance mindset. No, you can only drive the bottom line so far. You can drive the top line as high as you want to. But if you were looking at doing financial planning, one of the things that I recommend doing every year is look at all of your expenses. And it's very easy to do that on a bank statement, but people never look at fees. Like a fee audit at the beginning of the year, like if you don't know what you're paying in fees annually, we've seen people, especially our clients, our normal client who's got about $1 million saved, before they meet us, they could be paying $30,000 a year in fees.
Yeah. And who knows? It really will vary between people and retirees, how much they spend per year, obviously. But let's just say that you're spending, I don't know, let's just say $60K a year, roughly. If you have like a $500,000 portfolio and you're paying about 2% in fees, which honestly we've seen a whole lot of many times.
Ton.
Yeah, that is $10,000 a year in fees. So for, if you think you're spending $60K, you're actually spending $70. So, and that's like 16% of what you were spending. So it can stack up and you don't even realize it. So
yeah. And the thing is, before you look at the investment side, one of the things that are in your control as a retiree are the fees that you pay. So if you go through and you do this fee audit, whether you you try to do it yourself, or you come to a professional firm like ours. I know we do that for all of our clients before they become a client. We don't even charge people to go in and do a fee audit. We'll do a fee audit. It's complimentary. We'll go through and we'll look at, what are you paying your advisor? What are you potentially paying the products that you're in? And what are you paying in investment fees in the investments that you're in? Because a lot of times you could have listened to one of the podcasts that Luke and I have done in the past where we talk about index funds. And I know you and I both are big on the S&P 500. But if you own the S&P 500, you could have heard this in an episode before and been like, this is great. I'm in the S&P 500. But you could be in the S&P 500 in a variable annuity that you're paying 4% per year in fees annually. And there's absolutely no reason, why you should be doing that. So that is in your control, because the investment is going to do what the investment does. And if you think about the positive impact that can have, I mean, it's tremendous.
Oh yeah. And also, how you say that, like, every year at least you like to go through, roughly what you spend and kind of go through those line items and see what you can do to, I guess, be more effective in what you spend. I do the same thing, and I do use like an app to kind of go through the major line items. But if you think about things that people would typically look to cut if they wanted to spend less overall, to like have more of I don't know, if they want to save more or whatever it may be. Let's just say like having less daily coffees from Starbucks or canceling your Netflix subscription. When you think of that in the big scheme of things, compare that to like fees or a few other big things, because like, for instance, a $5 coffee for 365 days, it's about $1,800. And if you compare that to something a little more major, like fees, like who knows how much more impact is it going to have if you could just focus on this, on that area. So focusing on the big picture and then filtering down into the smaller things, I think is important.
Yeah. And the thing that we haven't even talked about, so I would say, for sure, mutual funds, for sure, product fees, like variable annuities, those are prevalent. Advisory fees, we've seen advisor fees be 2% before.
On everything as well.
Yeah, across the board before funds expenses, which is wild. I mean, in my opinion, what should you pay an advisor? You should pay an advisor what they're worth. So, if I'm paying Luke 2% per year, but he's making me 60% per year annualized, I don't care. Like, who cares?
That's worth it.
Yeah. And you're paying for a premium service and getting it. But it's kind of like, some people fly first class, some people fly economy. Like, why would you fly first class? Some people just like being seen at the front of the airplane, to be honest. Now, some people like the service. Like, I love to sit at the front of the airplane and the person comes around before the plane takes off. And they're like, hey, would you like something to drink? Like, and just that little bit of extra care and attention, I think is worth it. So I've always been willing to pay for a premium product or service. I'm not saying that just because fees are there, that they're a bad thing. You definitely want to, if the plane's coming down, and I always explain it like this, but with retirement, if you're flying in an airplane, and you have someone who is dedicated on landing that airplane, if there are things going wrong with the actual aircraft, if I could pay a pilot $120,000 a year or $60,000 a year, if the plane is going down, I definitely want the guy that I'm going to pay $120,000 a year.
You want the right person in the right seat, and, at the right quality, etc.
So paying a fee is not about. I'm not telling you that all investment advisory fees are a bad thing. When they're priced reasonably, they're actually the best thing that you can do, because you can make a decision that's rooted in data and backed by true studies that show, okay, this is the way that we should invest the money, or this is the way that we should act in this situation, and it's not you guessing.
And overall, in general, you obviously need to be getting what you're paying for. I mean, at our firm, we're comprehensive in our retirement planning. So, like, we're all National Social Security accredited advisors. So you will have Social Security advice. We have a tax planner on staff. So you get tax planning coupled with your investment plan. And also, when it comes to income planning, we have the right people in the right seats to make sure that your income plan is in alignment with your lifestyle and you're not going to run out of money. So, like, having the right people in the right seats, I mean, you get what you pay for, but you just don't want to be paying something unnecessary.
And the other thing too is you can pay behavioral fees. And what do I mean by that? I mean, that is emotional actions that you could take.
Right. Like if you don't have the right guidance, making the wrong mistakes. Yeah.
Correct. Yeah. Like if you hire a yes man, let's say, and the stock market drops by 30 or 40%, and you hired the yes advisor and you call him and you say, hey, I'd like to pull all my money out today and go to cash because I'm scared to death about what's going on in the world. Well, if you hire the yes man, he's going to place that trade. Or if you work with Fidelity or a tele-advisor where they're just an order taker and you go and you tell them to liquidate your funds, guess what they have to do? They have to liquidate it. Now, ultimately, as advisors, we would have to do the same thing. But what would we do? Like if I got a phone call and the market were down by 40% and it was a client that I cared about, which I care about all my clients. But if I got that phone call, I would tell them, I'd be like, honestly, I'd probably be blunt and I'd be like, this is really dumb. You shouldn't do this. This is going to negatively impact you in the future. Let me tell you all the reasons why it's going to negatively impact you in the future. And I would go out of my way to make sure that they aren't going to make a bad financial decision. And if they were, they would know every bad thing before it happened and they could never say they didn't know.
Yeah. Like we're like your partner in that situation, making sure you're not making the wrong decision. Ultimately, it's your money. We're gonna have to do what you say, but obviously, we're gonna encourage you to do what we really think is going to truly benefit you. And like we have the expertise and the experience to know when that might be the wrong decision, and we have your plan set up in front of us, so we know that it's going to be the right or the wrong decision.
Yeah, and I think the other thing too is it's not all about selling. It can be about buying. The money's made on the buy. You ever heard that before?
Yes. So like if you're buying a piece of property, for instance, or a piece of real estate, you're going to make most of your money if you can buy it at a good deal.
Yeah.
So when you buy.
So like if somebody calls, the office and they're like, hey, there's this, penny stock. I really want you to look, which I get questions like this fairly often. You'd be surprised. But somebody's like, hey, there's this penny stock. It's, let's say it's gone up by 500%. I literally have an email from a client in my inbox right now, and I'm about to email them back. But they're like, we should really look into this, but it's gone up by, 5,000% in the last 90 days. It's like, well, it's already happened. Like,
that's backward looking.
Yeah, that's backward looking. Like the fact that, hey, should I take $100,000 and put it into this? So we can keep people also from instituting a bad financial decision.
Yeah.
My rule of thumb is I'll never let a client make a dumb decision with anything more than 1% of their portfolio. I would tell them that, you wouldn't want to do that. I would tell them every reason why you shouldn't buy that. But at the end of the day, if they were like dead set on it, I'd be like, look, even if you put 1% of your net worth into it, if it goes great, phenomenal, you have some money in there. If it goes terrible, at least you only put in 1% of your net worth.
Yeah, it's not going to crush your plan.
Yeah.
So yeah, I mean, again, paying for what you're getting, that is part of it. Like as a partner, we need to make sure that you're making the right decision, and we'll encourage you to make the right decision. So,
and the last thing I would say about behavioral fees is they can be the most expensive fees you pay, even though they're invisible. I cannot tell you how hard it is for me to listen to some clients whenever they come in and they're like, in 2008, yeah, I went to cash. Like I just have to smile and nod because it literally makes me sick to my stomach that someone in their life was not there to lead them.
Yeah.
Like in that moment.
Yeah. You really do need someone to help lead that side of your life. If it's not an area that you truly are an expert in, like this whole area, like in retirement planning, there's a lot that goes into it. If you're not an absolute expert in this area, you really should have an expert that can be that leader for you and help, make sure that you're not making those mistakes and that you're in alignment with your plan.
If retirement clarity matters to you, don't wait. Text BOOK to 864-920-3155 or click the link in the description below to get a free copy of Johnathan's book, Retire Right.
And the other thing is, I think you brought this up though, dormant accounts.
Dormant accounts, yeah, definitely.
So if you've got, dormant 401ks, 403bs, IRAs, simple IRAs, any retirement account, if it's dormant from a previous employer, it could be subject to higher fees. Also, a lot of, especially small employers, they may have to use a custodian that would charge you a higher fee even to be in the plan, and then when you leave the plan, the fee gets even greater.
Yeah.
So you could have, not money disintegrating, but really money sitting level whenever it could be growing.
Yeah, that's a big fee too, is like opportunity cost. If you have these old accounts, I don't know, 401ks, even IRAs or simple IRAs sitting out there and you don't have your eye on the ball, there could be multiple things that are degrading that value. Like there could be fees you don't know about. You could be investments that are expensive and not returning what they should. You could also be, maybe it's not even reinvesting the dividends, so you might be losing the value that you should be getting from reinvested dividends. So those are all going to be costly.
And it could be in cash. I mean, yes, that a small employer, that money could have just gone and that could sit there in cash. I mean, I think one of the other benefits about having an advisor, that's DIY versus delegation. How many times a year do we get an email from Amy? She's our compliance person on the team, but Amy saying, hey, here's the cash report for all the accounts in the firm. Luke, hey, go check your, here's all the accounts that could have, and all of our advisors are great. They're all going to go through and make sure, everything is invested the way that it should be. But there's also systems on the back end to make sure that these things are done correctly.
You don't just want a pile of cash sitting there not working for you if it's just sitting there. Yeah. And that's another great thing about using a professional like us, is that part of our service is obviously rolling over and pulling those accounts into your active accounts, so you have your eye on the ball and we can actually get it invested properly. Because if you have like an account worth hundreds or tens of thousands of dollars even sitting there doing nothing, that really is money that could be working for you.
Oh, 100%. And the other thing too is you have a team around you. Like, for instance, with the Amy email example, I mean, we've got, not only are you or any advisor, they're doing the actual investing of the money, but if they have the right team around them, there's so many different touch points for the client to make sure they're getting the service they actually deserve.
Yeah, definitely. And, even we want to cover all of the bases. So like even accounts sitting out there that we pull over and pull in, yes, even sometimes it could be a drop in the bucket, but every drop that goes into that bucket, once it's full, that means your dreams can be realized. Like that can be giving you your dream life.
Oh, 100%.
Once it's there. So it all counts.
Yeah. I mean, there was a client right before we did the podcast, I don't know, 30, 40 minutes. They had about $1.5 million. I was just going in, checking on their account, saw they had gotten a cash dividend. It was like $6,000. Just reinvested that into more. I mean, $1.5 million client, $6,000. It's not even, 0.5% of their net worth, but making sure that money is working for them.
Yeah, it all counts.
Yeah. Watch the pennies and the dollars will take care of themselves.
Yeah, I love that.
Someone taught me that.
I love that. That's a great quote. I don't remember where that came from, but it's a good one.
I don't know either. Yeah, I have no idea.
It all adds up.
And the last thing that I want to talk about is how we do fees here. I think it's one of the most unique things that have helped our clients achieve their goals and live their dreams, not their worries in retirement. And it is all about not billing on a certain side of their assets. So I'm going to have Luke talk about that. But the way that we see it is, if fees, risk, and taxes are in your control, those three things, it's our job as a fiduciary to try to limit those to the extent that we can and still be profitable. Like the building that we're sitting in right now costs money. These microphones cost money, right? Everything to run a company, it takes money. But I believe that when you truly take care of the client and you charge a reasonable fee, what you're worth, and then you do a really good job for them over time, that, that's why 34% of our business last year came from introductions from current clients, things we didn't pay for in marketing. That's just them organic out there beating the streets for us. So if you're listening to this right now and you're a client, I do appreciate you doing that. But I want to have Luke talk about that, which is, what is our philosophy on fees? Because we do work with clients who are in a different stage of life.
Yeah, so I truly believe that, like, here at our company at Big Money, you do get what you pay for, 100%. I mean, with everything that goes into it, like, this is the most comprehensive company that I've ever seen on, like, retirement planning. It's pretty incredible. Like, even when I was, like, job seeking a long time ago, when I got introduced to big money, it was almost incredible to see how everything is covered.
Yeah.
We're not just managing money. We have national social security advisors, we have tax advice, we have income planning, insurance planning, investment planning, everything. But so you really do get what you actually pay for. And also on fees, it is definitely reasonable. So, how we always say you have your cash bucket for safety and liquidity, your safe income bucket for income, and you have your growth bucket for growth. We only charge a fee on the growth bucket, which I think is incredible. And it's a nice way to really give back to our people, our retirees, our pre-retirees, the people that we love and work for. And so you're not getting handicapped on the low yielding assets like cash. Like right now, if you're getting 4% on cash or even bonds as well, and we're charging you 1% on that, it is a quarter of your return gone. Proportionally, it's a lot on low yielding assets. So it makes sense to charge on the growth assets, but outside of that, it doesn't make sense as much. We make money. Obviously, every company needs to make money, and we're a fiduciary, but fiduciaries can make money too, and we can still be a successful business. We get paid in different ways, like even insurance companies can still pay us, so we're okay. And you want your companies, the company you work with to thrive and do well, obviously. But the only fees that you see as a client, as a person that we work for, it's only on the growth side, which is always pretty reasonable. So if you look at everything overall, it's actually a pretty reasonable fee. On average.
I think we range, it's anywhere from 0.5 to 0.75.
On everything total
per client, which is very aggressive. And I don't know a lot of firms out there that do it that way. And again, we're always going in and I'm looking at all the client assets literally every day, every business day. But I pulled a cash report today, like going through looking, seeing which clients have money in money market. Is there any areas of opportunity for improvement for any of our clients? And I looked at it and I was like, if we charged a fee on these money market accounts that our clients have, it's literally hundreds of thousands of dollars that we could be making every year. But at the end of the day, I know that our clients are making 25% more than they would working with any other advisor in the zip code.
Yeah, who charge a flat fee on everything. Well, many do.
Yeah. And I think that is why when you look at the statistics of the number of new clients we get from current clients, I think that's an investment in our clients. And that to me is, money will only get you so far. Relationships to me are everything. And when you look at the relationships that we have, I kind of chuckle whenever I'm like, I can't imagine like some of our clients going into another financial advisor's office. It really, it gets me sometimes because I'm like, what would they like say? And obviously I'm biased. I'm very biased.
But still, how would that go?
But how would that go? When you look at the returns, when you look at the relationship, the money's there, the relationship's there, what more could you need? Like it's, I think if we did anything else, it'd probably be illegal. So,
well, we really do strive to be the absolute best in the world at what we do. So like I do think that we do offer a very premium service for what you pay.
And at the same time, I think the fact that we're all willing to learn, we don't go into any meeting and like beat our chests. We're like, what can we learn today? Who can we place around us? We have that day one mentality here. It's like, what can we do to improve? Like we always want to know. So
it's not the same year of experience repeated 20 times, like 20 years of experience, quote. In other words, we're actually learning constantly, all the time. Every year is new, and we're in high growth mode as well. We're doing well for our people, and so we're growing. But that comes with its own challenges, and we're learning so much as we go. So we're getting better and better every day.
100%. And I'm going to leave you with this final thing. So not tomorrow, Monday, we're doing a little team bonding. Okay, so we have an event that we're doing. We're doing paintball. This is Luke's first time ever being shot at. So it is. So I want to leave you with this. Number one, we appreciate you listening today. I'm glad you took the time to invest in yourself. It's very rare that you find someone who's willing to learn like you are, and I just want to commend you for that and for having that day one mentality. keep doing what you're doing. Keep learning more about retirement every day. And if we've been a part of that here, I would love to get your honest rating and review. So make sure to leave your review, and Luke and I will start reading those off at the beginning of every podcast. I think that would be a ton of fun. But if you're watching on YouTube, make sure to leave comments below. And if you're listening on Apple Podcasts or Spotify, leave your rating and review, and we'll start reading those next week. But thanks for listening to this episode of Build Big, Live Bigger, and we'll see you on the next one.